now we have the dynamic duo of Scott McHenry and Andrew Rinn. If you don't know Scott and you're in the qualified plans arena, you are missing the boat because you really should know Scott. Scott is an actuary and he started McHenry Advisors in 2006. And he has grown it to one of the largest retirement actuary firms in the country and is serving a whole lot of clients. He is really just a leader on qualified plans. And I'm hoping most of you know Andrew Rinn, or you missed that 7702 webinar that we did in August, which if you would like to see, you can see in the archives of the Advanced Practice Center. But Andrew is the Vice President of Advanced Markets at Emeritus, where he leads that team. He is a frequent speaker, as I said, and before joining Emeritus, he was part of MetLife and worked with Snoopy. So I'm going to leave it to these two because they've got a really great, robust presentation they want to do. Remember, please put your questions in the chat and we will get to those at the end.
Awesome.
So, Andrew, Scott, take it away.
Wonderful. Carla, can you hear us?
I can hear you great.
Wonderful. Can we hear you, Scott?
Sure, Andrew.
Awesome. Beautiful. Well, I'll go ahead and kick things off. Thank you very much. Appreciate the nice introduction, Carla. So Scott and I are very excited to be here today talking about the role of life insurance within qualified plans. So we're going to do a tag team approach today. This is a newly completed and approved presentation that both of our respective teams worked on very hard. So hopefully the audience, those listeners here today will enjoy it. So I'll go ahead and kick things off and start out this way. So, there's a strategic role life insurance has within qualified plans. It's not for everyone, but for the right type of business owner with the right type of census and the right type of goal, it might be the strategy or the technique that's going to work. So having this in your arsenal of ideas and strategies, especially in this day and age, is really important. We're in turbulent financial times, and now we're in inflationary times. Business owners are looking for ways to go ahead and bridge that retirement gap between where they are now and where they want to be when they retire. And this could be one of the solutions that enables one to go ahead and do that. I did think we were going to have a presentation up here today. Carla, were you going to pull that up?
I can pull it up, Andrew, if that's easier for you.
That'd be great. Thank you, Scott.
Arena, you are missing the boat because you really should know Scott. Scott is an actuary and he started McHenry Advisors in 2006. And he has grown it to one of the largest retirement actuary firms in the country and is serving a whole lot of clients. He is really just a leader on qualified plans. And I'm hoping most of you know Andrew Rinn, or you missed that 7702 webinar that we did in August, which if you would like to see, you can see in the archives of the Advanced Practice Center. But Andrew is the Vice President of Advanced Markets at Emeritus, where he leads that team. He is a frequent speaker, as I said, and before joining Emeritus, he was part of MetLife and worked with Snoopy. So I'm going to leave it to these two because they've got a really great, robust presentation they want to do. Remember, please put your questions in the chat and we will get to those at the end.
Awesome.
So, Andrew, Scott, take it away.
Wonderful. Carla, can you hear us?
I can hear you great.
Wonderful. Can we hear you, Scott?
Sure, Andrew.
Awesome. Beautiful. Well, I'll go ahead and kick things off. Thank you very much. Appreciate the nice introduction, Carla. So Scott and I are very excited to be here today talking about the role of life insurance within qualified plans. So we're going to do a tag team approach today. This is a newly completed and approved presentation that both of our respective teams worked on very hard. So hopefully the audience, those listeners here today will enjoy it. So I'll go ahead and kick things off and start out this way. So, there's a strategic role life insurance has within qualified plans. It's not for everyone, but for the right type of business owner with the right type of census and the right type of goal, it might be the strategy or the technique that's going to work. So having this in your arsenal of ideas and strategies, especially in this day and age, is really important. We're in turbulent financial times, and now we're in inflationary times. Business owners are looking for ways to go ahead and bridge that retirement gap between where they are now and where they want to be when they retire. And this could be one of the solutions that enables one to go ahead and do that. I did think we were going to have a presentation up here today. Carla, were you going to pull that up?
I can pull it up, Andrew, if that's easier for you.
That'd be great. Thank you, Scott. And so I'm just going to go ahead and hit the high level agenda here today as we pull that up. So this is kind of our game plan, if you will. We're going to spend some time focusing in on, thank you very much. Just want to go to the second slide there. Third slide, beautiful. Thanks, Scott. Who are the candidates? Who are the proper clientele for this technique? So a little hint, it's going to be business owners, but it's going to be a little bit more than that. That's going to be key. And then, secondly, we're going to be hitting, the strategy, kind of the big why. Why would you want to do this? What type of individuals would engage in this? Is it because they're looking for income tax deductions? Because the investment vehicles using insurance could be self-completing? Are they looking to cover transfer tax concerns? So that's huge. Then we're going to get into some fun case studies. So we're going to be talking about Tom, the dentist. And so we'll hit the three primary concerns that Tom is asking. So that's going to bridge the gap between the theoretical and the practical, the more pragmatic. Scott's going to go into two really, really uber cool examples, comparing what we call split-funded DB plans and insured plans, what's now known as 412(e)(3) plans, comparing the two, going over the advantages and disadvantages. Then I'll hit some of the exit strategies. What I mean by that is, if you utilize life insurance, what happens with it at the end of the day when you retire or terminate the plan? That's usually the million-dollar question. Okay. So let's go ahead and go on to the next slide, even beyond this. So this is the client we're looking at here. So typically you're looking for somebody that's older. And when I used to do a similar presentation, I wasn't in the older demographic, but I am now. So when I say older, I'm typically meaning somebody that's, 40 to 45, preferably 45 and up. And the reason for that, and it'll become evident very shortly here, is we're looking at a defined benefit arrangement, which helps and benefits people that are older as far as being able to make bigger tax deductions in shorter periods of time. Number two, we're looking for few employees. We don't want a huge census. We don't want 60 employees. We could have 10 or less, or even 5 or less. Sometimes having just single owner or 2 owner plans work extremely well. This is an ERISA covered plan. It is a qualified plan. I can't emphasize that enough. So we have to cover all eligible employees. And so you want to go ahead, if you're going to engage in this strategy as a business owner, I like to call this like an all about me strategy. They're looking to benefit, frankly, themselves at this point in their life. They need those additional retirement savings because there's that retirement planning gap. They put all their energy into the business itself. They haven't saved for their own retirement. Think of business owners you might have out there that kind of fit that niche, all right? They just set aside large amounts of money in a short period of time in a tax deductible way. I have to think there's lots of clients out there that are just like that. Number 4, significant, or you need significant, but sufficient cash flow as well. Think of the game that some of us had when we were kids, the Hungry Hungry Hippo game. You have to have, this business has to be kicking out a fair amount of steady and significant profits, excess cash every single year, because you want to be able to feed this plan. So there's certain sorts of practices that work well with that. Typically, doctors, dentists, engineers, other sufficient cash flow practices. I worked with one of our top advisors here at Emeritus, and we implemented something like this for a towing company. So you heard me correct, a towing company. So it could work well for them as long as the cash flow is significant. We're looking at insurable individuals that can get life insurance on them. And lastly, although this might traditionally have been a small concern, because of from perspective tax legislation, I know Stacy kind of talked about that a little bit. And somebody that might have an estate tax liquidity need, this might be an arrangement that works well for them. Okay, let's move on from there. Okay, so I've alluded to this. I've put everything into my business. I want to catch up. What can I do to set aside large amounts of money in a tax deductible way for myself? That's the candidate we're looking at here. All right, let's move on. I'm gonna have to give Scott $20 for doing my slides here. This was not part of our deal. So appreciate it, Scott. I like this slide. Again, we're kind of building up the clientele, the candidate here. This is what we call the retirement planning gap slide. If you look at an individual that's making $100,000 a year, and that's not chump change, but with a traditional 401k, and I'm ignoring catch-up contributions if you're 50 or over. With a 401k, you're looking at being able to put aside $19,500 a year, easy math, 19.5%. Look at the fundamental shift. Look at what happens. Look at that growing gap when you make more income through time. You're making as little as $350,000. You could only set aside 5.6% using a traditional 401k plan. This is not what business owners and that demographic that I just got done describing are looking for. They're looking for something more. So let's talk about something more. Let's move on. Okay, so these are some of the additional concerns for business owners. So again, as you kind of consider and conceive the profile for this scenario, just think about some of your client business owners that are looking for the larger tax deductions. With the prospect of having a top marginal tax rate of over 39%, plus the surtax of 3.8%, plus a possible 3% on top of that if you make 5 million or more. Just looking at federal income tax alone, if some of the tax provisions go through in this expected bill, you're going to be looking at some of our business owners. If you throw in state income taxes, that could be there could be a 50% tax bracket, 5-0. They're looking for tax deductions now, but in the future more than ever before. They want to protect their assets from predators, from creditors, attorneys like me. So you put money and assets within a qualified plan, they are creditor protected. Obviously, you can't engage in something we call a fraudulent conveyance. So that's a whole nother seminar in itself. Just know it's a great tool at the end of the day if done appropriately. This could be a great tool as well if you look at the concerns of these business owners to set aside some of their inheritance for their kids. And what I mean by that is some of the prospects for this strategy. They might be lawyers, doctors, engineers, whatever the case might be. They might not have kids to hand this thing off to. They might not have successors. So I always like the idea of substitute business value. This business might not be worth anything hardly without the business owners themselves. So how can you create value for your family at the end of the day? Well, one way to do this is leveraging insurance products, investment products within a tax protected wrapper of a qualified plan to essentially provide that inheritance for the beneficiaries at the end of the day. If you approach it that way, that could be a great way of looking at this. Will my business be worth when I retire? That's what they're asking. Will my business have to be sold to pay estate taxes? This is not the panacea for all, but it can answer a lot of these questions. And let's move on here. So the strategy, defined benefit plan. So we're going to go into, Scott and I are going to have a lot of fun here with you, and you're going to ask some questions, I'm sure, but high level defined benefit plans. Again, this is what we're looking at here. And most of you listeners here today, very educated, you know what DB plans are, even though arguably they've fallen out of favor the last 15, 20 years. In my humble opinion, we're on the verge of a renaissance, a resurgence, if you will. And to a certain degree, we've already seen that. Lots of reasons for that. But high level, it's a predetermined death benefit at retirement. Contributions, what you could put in, what you could deduct every single year, are going to be based upon performance. What are the underlying investment returns of the assets within the plan itself? Potential, this should be the attention getter, potential for large income tax deductions. This is usually, I can do an entire seminar, and Scott can as well. As soon as we say tax deductions, people start listening. Maybe I should have that as the first bullet point. So contributions are tax deductible. There's a limit. We'll talk about those very shortly. Investment risk is assumed by the employer in most cases. There's some exceptions to that depending on the type of plan that you're looking at. I know Scott's going to hit some of that as well. Just know with DB plans, you're looking at your top 3 highest years of earnings, the lesser of that, or $203,000 a year. That's how much you could be entitled to at retirement, which is far in excess than the measly amount that you could, stack away in some traditional retirement plans. So this could very well be something that these arrangements can provide. Let's move on. So leveraging pre-tax funds to close that gap. So visualize that gap. I've been in client meetings with business owners and advisors. They'll actually draw out that retirement planning gap to emphasize what we're trying to do with this strategy. That's very effective. Tax deductions, it's self-completing. I want to pause just a moment on self-completing. What we mean by that is if life insurance is one of the funding vehicles, for the most part, and I'll kind of discern between what's taxable and what's not, but for the most part, a large part of that, those death proceeds are going to be non-taxable, even though the policy is within the qualified plan. You heard me correctly. And think of other qualified plan arrangements that would meet that. So if you have the plan participant pass away, can you magically transfer those plan assets into non-taxable assets for the beneficiaries, for the spouses? No. But utilizing life insurance, you can do that, at least for a large portion of that. Kind of a sneak peek, it's going to be the non-taxable portion is going to be what they call the pure amount of life insurance protection. We'll hit that in some of the other slides. Estate planning. And this is going to be the last part of our presentation today. We'll talk about how to leverage and utilize that life insurance for your estate planning needs. Let's say you've retired, you've terminated, you've left employment. Is there a way to utilize that life insurance and other investments for your other estate planning needs? Again, I think estate planning, it has already, it's going to become cool again. It's going to become a thing to talk about. It's something that we need to be discussing. And the substitute business value, I think I hit that pretty hard before, so we can move on to the next slide. Okay, $1 million question. How much can be deducted? And, you got Scott and I here, we're, CPA attorney type. So we're not going to answer that directly. We're just going to say it depends. So I'll give you more than that, I promise. So the point I want to make up front is, a little more time on this slide. The life insurance has to be secondary or incidental to the ultimate goal of the retirement income. And I hate reading slides, but I did it right there because I think it's important to do that. Life insurance can't be, wagging the dog here. It has to be incidental. It's important, has lots of benefits, but it has to be secondary or incidental. And I'll quantify what we mean by that as we move on here. Okay, so there's various tests, and we're not here to make you experts on the incidental benefit test determining how much can be deducted. All I want you to know is have a high level idea of kind of how it's treated. So split up, think of it in two ways. What we call the less than percentage test, which applies to DC or defined contribution plans, and the 100 times rule, which applies to DB plans, defined benefit arrangements. So first, let's go ahead and hit defined contribution. So if you utilize a universal or a term product, less than 25% of your overall employer contributions can be represented by life insurance premiums with those products. If you use whole life, and that's why whole life is so popular with this technique, that number goes up to 50% of total employer contributions. So whole life, and I'm not going to get into my cohort and crimes presentation here because he'll probably hit this a little bit, but whole life, because its underlying guaranteed rates offer a lot of assurance that the defined benefit targets are going to be met at retirement. Thus, the IRS is a lot more comfortable allowing that to be a lot larger part of the overall contribution and deduction to the plan. All right, defined benefit. That's the second one here. So we got something called the 100 times rule. So we all know what defined contribution and DB plans are, but with DB plans, the death benefit, the incidental rule that applies to that, the death benefit can't be more than 100 times the expected monthly benefit. Now we'll know working through a TPA and an actuary like McHenry and Associates what that number is going to be, but it can't be more than 100 times that. This is the fun part. You could actually look at both of these tests to figure out what contribution is going to work best. You have this funky revenue ruling, and this might be as geeky as we get here today, Scott. I don't know, called 74307. All right. So all that does is allow a DB plan to be treated as a hypothetical defined contribution plan for purposes of the incidental benefit rules. What that often allows you is to go ahead to do is to piggyback on those DC rules to be able to deduct more amounts for the business owner at the end of the day. You don't have to worry about calculating that. I just wanted to kind of illustrate high level that these are the two rules that applied. We actually had an easy out with the 74307, which will allow us even larger deductions if we want them. We can move on.
Andrew, can I add just a kind of practical point? You know, what I see is, you know, in the marketplace, if we're trying to maximize a pension plan for a business owner, if they're under, say, age 45, probably the 100 times method is going to give us a larger amount of life insurance that's available. After age 45, almost always, we're going to get a larger amount of premium that can be paid using the 74307 method.
Excellent. Thanks for pointing that out, Scott. It makes it a lot more real for the audience here. Okay, well, we're going to visit my friend Tom. He looks a lot like my brother-in-law, so I always like using him. So Tom is a dentist, so he's 50, married with children. He has about 15 years until retirement. He might soon, because he's very successful, be in that top tax bracket, which we expect might be around 39%, but right now he's just in 35% tax bracket. He's one of those business owner candidates that I was referring to before. He has significant and steady cash flow. Think about, you know, the audience here today, your own dentist. It's usually a couple dentists, maybe a dental hygienist, a receptionist, small offices, large amount of cash flow. These are the people that we're looking for. Concerns retirement income, really likes those tax deductions, those income tax deductions, wants to replace lost business value, and has a need for estate liquidity. Let's move on. Okay, Tom has 3 questions. What's this going to cost me? What are my out-of-pocket costs? If he dies before retiring, how much of the policy's death benefit will remain tax-free? And what is the tax impact of the policy is distributed at retirement? So if he retires, how does that impact him from a tax perspective? And if you look real close at the slide, you can see Tom calling you with those 3 questions, because I often get those questions from the advisor. So let's hit those head on. Okay, pre-retirement tax cost. Let's say we're looking at a $1 million, emeritus whole life policy, age 50, standard non-tobacco. It'll be a $22,000 annual premium. Again, he's still in the 35% tax bracket. His out-of-pocket cost is going to be extremely low. There's something called the economic benefit cost. And it's a lot easier than even 74,307, which we kind of went through before. All this is Tom's out-of-pocket cost for the pure amount of life insurance. The pure amount of life insurance is going to be the death benefit minus the cash value component. The difference between those two numbers is the pure amount of life insurance. And that's what Tom pays rent on. He pays tax on the economic benefit of that. Now, there's certain tables out there. There's something called Table 2001, used to be the old PS 58. Some practitioners still call it that, even though they're different tables. There's a company's alternative renewable term rates. Both the 2001 table and the ART tables can be used to calculate the economic amount. And it's a certain amount of cents and dollars per thousand of life insurance. That's how you calculate it. All right. So that's what we're looking at here. And the younger the insured is, the smaller the cost is going to be. These tables, the rate per thousand gradually go up as the participant and the insured in this case age. But you could see for $1 million of life insurance, it's still employee out-of-pocket costs are going to be extremely low. So essentially, we're just taking the economic benefit amount and multiplying it by the tax bracket and a factor from the table. I'm not here to go through the math, although it's kind of fun and easy, but I just wanted to let you know my point here is it's kind of a small out-of-pocket cost for the amount of insurance. Let's move on. I got a request to stick this table in after I'd done a similar presentation a few years ago. At first I was reluctant, but now I'm happy that I did. It just kind of gives you a visual of what I just said. You can see through time the income tax-free component is in blue. The small amount subject to tax is in red. Again, that's going to be the difference between the death benefit and the cash value component through time. Let's move on. All right. Question we get, and when we talk about exit strategies, one of my favorite topics at the very end, we'll delve into this a lot more, I promise. But let's say, we've looked at Tom, what's his out-of-pocket cost? What does it cost him all along? What does it cost him at retirement? In this case, it's 65 for him. Well, using our example here, what they call the fair market value of the policy is going to be $330,000. I'm going to revisit that in just a little bit, what we mean by fair market value. The cumulative taxable insurance cost, those are those numbers through time I was showing you before, are $75,000. So the actual taxes paid are going to be 35% of the $254,000. 254 again is the fair market value. You're allowed to go ahead and get a credit, if you will, for the taxable insurance cost you've paid out of pocket. So you get credit for that, and you only pay taxes on the difference. So if the policy itself is distributed from the qualified plan, that's what Tom, at the end of the day, would be paying by way of taxes. Think about fundamentally what's happened here is you've had your business in a tax-deductible way subsidize, and in many cases, largely pay for a life insurance policy on your life, which at the end of the day, and you don't always want it back, but at the end of the day, if you want it back, need it back, you can go ahead and get that, usually at a very reasonable price. So again, we're going to talk about exit strategies and things like fair market value and some other trust things at the end of our presentation. Again, I just wanted to give you an idea, high level of what it looked like. We can move on. I love this table. This was my special request as well. Everything that I just got done talking about is lined up column for column from year 1 to year 15, going over the taxes that are paid, the portion of the death benefit, and the cash value. So I know this presentation is going to be available to share, so that's a very handy table as well. putting the pieces together, if you will. Okay, let's move on. Okay, at this point in time, I'm done with my first leg of the relay race. I'm handing off to my good friend, Scott. He gets the really fun part. I'm jealous. He gets to actually go through the plans themselves and really illustrate and verbalize the vast leverage and impact of what these arrangements might do for you and your business and our clients. Scott, it's all yours.
Great, thanks, Andrew. So what I was going to talk about is I just have a sample employee census, and I was just going to show kind of a building block approach as far as qualified plan design, where they might start off with in a 401k plan, add on a pension plan, and then talk about really two different types of pension plans that we can use, and illustrate the example, but also give you some ideas, some talking points throughout. So big picture, when I show these pension plans, I'm going to show them funded with a split funded approach, meaning that the pension plan includes both life insurance policies as well as an investment component. Could be a brokerage investment account in the name of the plan. It could also be individual annuities. Everything I'm going to show you here satisfies IRS non-discrimination testing rules. So our overall approach is going to be, how much can I design the plan to provide tax benefits to the business owners? What would I need to provide to rank and file employees based on that design to satisfy all IRS non-discrimination testing, knowing that we can always give more towards employees if the owners wanted to give more to those employees. I am going to show you including both a pension plan and a 401k profit sharing plan. Usually if we have rank and file employees, that is going to be the go-to design, because we get a better cost structure in terms of contributions that are made towards employees than if we did only a pension plan. If we have an owner-only group, no rank and file employees, it's very common that we would only do a pension plan in that instance. So our business owners here, Richard and Jane, both are a married couple, both working in the business. I'm going to show you kind of what they had when we first started working with them. They had a 401k plan. Richard had contributions annually $64,500, Jane $15,500, so a total of right around $80,000 total contributions that they can make to a 401k profit sharing plan. But they wanted to go higher, so we started to talk about adding a pension plan for them. So here's the employee census. For some calculations, I'm assuming a 42% effective tax rate, pretty close to what we have here. I'm in Ohio, 37% highest federal marginal rate, 5% Ohio tax. The employee census, Richard has a fairly large W-2 compensation. Jane has a more nominal W-2 compensation. And then they have 3 employees of various ages, one that's close to their age, 2 employees that are a little bit younger. Total W-2 compensation for those 3 employees is $120,000. So to start off with, this is kind of the as-is example, right? Before we were introduced to them, they had this set up. It's very common. A 401k profit sharing plan. Total contributions going in for Richard and Jane between 401k salary deferrals, which could be pre-tax or Roth, and company profit sharing contribution totals $80,000. $64,500 is the current limit for Richard based on his age. Jane has a more moderate contribution based upon her W-2 compensation level. And then the employees are getting right around 5% of their compensation. That is they can make 401k deferrals above and beyond this amount, but that 5% of pay in a profit sharing contribution allows Richard and Jane to have maximum 401k profit sharing contributions. So, big picture, this is a pretty good design. Richard and Jane are getting the lion's share of the contributions going in, so it's a tax benefit for them. The employees have a great benefit, 5% of their pay contributed by their employer, which is a terrific retirement program. But Richard and Jane wanted higher contributions. So they're introduced to, an actuary that designs them, well, what's possible if we add on, in this instance, a cash balance plan. So they already had the 401k plan. All we're going to do is add on a separate plan called a cash balance plan, a type of a defined benefit pension plan. Based on Richard's age, between these two plans, his contributions can go up over 300,000, up to 333,000. Jane, we can get her contributions up to 38,000. So again, these are more than their W-2 compensation, and that's completely acceptable in a pension plan, a defined benefit plan, a cash balance plan, or as I'll talk about in a minute, a fully insured pension plan. So it's a win for Richard and Jane here. If they have the cash flow and they want larger contributions, they are dramatically increasing what they can contribute to the plan, to the tune of almost 300,000 more than they were contributing to their 401k profit sharing plan. Their employees get more too. So it's a win for the employees. They're getting, roughly around 11% of their pay between company profit sharing and benefits provided in the cash balance plan for them. So again, lion's share of the contribution going to Richard and Jane. The employees are getting a healthy contribution, but the tax benefits that Richard and Jane are going to get by making these larger contributions are going to be significantly more than the additional contributions that they're making for their employees. And then showing this split funded with part of the plan contributions going to fund life insurance policies. In this example, I'm showing an IUL policy. So same policy type for everybody, just different total amounts based upon their pension benefit. Richard's able to fund a policy $124,000 a year, has an initial face amount just a little bit over $2 million. Jane, $255,000 as a face amount. And then the employee is more of a nominal policy. Again, same policy type, that's important, but at a lower level based upon their lower pension benefit limits. So kind of a snapshot side by side, almost 300,000 more for Richard and Jane. Employees are about doubling their contributions, but Richard and Jane are getting 90, I think in this instance, about 96% of the total contributions going in. And I think, that percentage is something when we do a plan design illustration that we always focus in on. This works great with 3 employees. I can tell you it's going to work great with 10 employees, but at some certain level, call it 25, 30, 40 employees, it starts to look not as good. If Richard and Jane are only keeping, 75% of the contributions going into the plan, then it becomes a little bit marginal. Are they better off funding the pension plan, or just paying income tax and investing outside of qualified plans? So it's always important to kind of know these numbers up front when you're working with a client. A couple things that the pension plan, allows very high levels of contributions. There is a ceiling, roughly $3 million. It's different based upon everybody's age. But, at some point in time, if Richard and Jane want to roll over to IRAs, a lot of times we'll fund a plan for maybe 10 years before hitting the ceiling on what can be distributed out of the pension plan and rolled over to an IRA. Another consideration is these plans can always be scalable. So while I'm showing kind of a max funded plan here, we could always dial down a lower contribution amount. So if your client had a budget for 200,000, certainly a pension plan is still going to make sense. We can take them from 86,000 up to 200,000. Richard and Jane are still going to get most of the contributions, but we've kind of tied in what their budget, what their budget is as far as contributions. And with this type of a plan, with a cash balance plan or a traditional defined benefit plan, we have flexibility. So we can design the plans and allow them to make larger contributions in really good years And there are ways where we can build in flexibility so that they could dial down contributions in lower income years where they want to make a lower contribution. So again, a summary, the additional contributions going from their as is 401k only to adding the cash balance plan, just shy of 300,000 more. Richard and Jane are getting 97% of those contributions, plus having, funding these life insurance policies that have a very strong death benefit. A couple considerations for cash balance plans or defined benefit plans. Number one is you do need an enrolled actuary. So an enrolled actuary has to certify to IRS, in some instances, the Pension Benefit Guaranty Corporation, that the plan has met all of IRS required funding requirements. So certainly, pension plans are going to be more expensive than a 401k plan by itself, and as far as TPA or plan administration fees, because it needs the enrolled actuary. But I think when you dial into the numbers and you look at the tax benefits that the business owner is getting by adding a pension plan, then the administrative cost almost becomes not, very nominal. There is, the one thing that's very important is to keep an eye on the ultimate maximum pension benefit limits. If the plan is for the individual to, at some point in time, terminate the plan, the business terminate the plan, and for the owners to roll over investment assets into IRAs, then it's always important to keep in mind, well, what's the end point? What's the exit strategy, for the plan as a whole to get those dollars out of the plan without tax consequences into an IRA? So for that reason, a lot of times the investment allocation may be a little bit more conservative. A brokerage account that's managed, targeting 4 to 6% annual return, will never get anybody in trouble. On the same token, you could use different types of annuities to fund the investment component, which kind of dials in some of that more conservative investment target.
Hey, Scott, I'll ask a question here that pulled up in chat. How would the business hire an enrolled actuary for the split funded plan?
Sure. There are, all around the country, there's third-party administration firms. Some of them have enrolled actuaries that are employees that can work with the business owner to set up the plan. There are some third-party administration firms that outsource actuary work. All those are feasible. Certainly we, are a third-party administration firm, have actuaries, design plans for closely held business owners, all day long. So, I think that's kind of what you're looking for, through the financial advisor, through a CPA or maybe attorney. It's just access to a third-party administration firm that can offer these plans to your clients. So what I also wanted to talk about, so this is a 401k plan and a cash balance plan. Let's say that the business owner in this instance wanted to go even higher in contributions. Then oftentimes what we will look at is what's known as a fully insured plan. 412E3s, the code section now, used to be 412I. The concept here is it's still a defined benefit pension plan. Still has a benefit that's written into a plan document. The difference is that plan, can only be funded by whole life insurance and fixed and flexible premium fixed annuities. So we lose a little bit of flexibility, and I'll talk about this and show you, but we gain a little bit in that we can have higher levels of contributions. So if you have a business owner that's, probably in their 50s or 60s, the employee census becomes even more important here, but wants very large contributions and is okay with giving up a little bit of flexibility in the investment allocation, then a fully insured plan or a 412E3 plan, can definitely work. So going back to our, case study, Richard and Jane We showed what they could do by adding a cash balance plan, same employee census, but they wanted more contributions. They, had some great contracts. We're going to have terrific income for a period of years, and they wanted to dial up their contributions. So what this is showing is a 412(b)(3) plan, and a 401(k) plan. Contributions can go significantly higher, because now we are the investment component, and the plan benefits are based upon insurance company guarantees. So from the business owner perspective, we've taken all the risk off the table. Their contributions can go significantly higher, between Richard and Jane up to 600,000. Larger amounts of life insurance available because we're doing whole life insurance in this instance instead of an IUL. So where we have, extremely high income business owners without employees or with very, very few employees, we'll look at this as a solution. But, there is a little bit of a drawback here in that if there are rank and file employees, here we have the 3 employees, W-2 compensation of 120,000, based upon the way fully insured plans are structured, the contribution cost for the employees goes up pretty dramatically. So it would be important to kind of talk about this up front, get feedback as far as how the business owners are concerned, with the level of contributions towards employees. So if this was Richard and Jane only, and they wanted maximum contributions, this would be the best fit for them. Since they have a few employees, it may be borderline, depending upon how they feel about that level of contribution for their employees, to do this design rather than the earlier one I showed you with a little bit lower contributions for them, but they're getting a larger percentage of the total contributions going in. So 604,000 compared to 372, but the employee cost is dramatically different. Fully insured plans do not technically require an enrolled actuary. I would say a lot of times enrolled actuaries work on these plans because they still are complicated. They still need some levels of IRS testing. The good news is we've eliminated concerns with over or underfunding. We've kind of taken that flexibility out of the equation, and the contribution is just what is calculated to be. The insurance company bears all the investment risk. The one, other kind of important thing to consider is with these levels of contributions, at some point in time sooner, we're going to get closer to what could ever be rolled over to an IRA under IRS limits. So it becomes important with fully insured plans with that levels of contribution, to always have that conversation. Are we going to terminate the plan and roll over to an IRA, or are we just going to annuitize these benefits at some point in time?
Okay, Scott, before you hand the baton back over to me, I have another question for you. With a fully insured plan, can it be an all annuity arrangement, or can it be a combination of life insurance and annuities? And I know that's subject to the 50% limit I was talking about earlier, but how would you answer that?
Yeah, you certainly could do a fully insured plan that is annuities only. We haven't seen that many of them, recently, just based on where interest rates are, right? They're large contributions. You generally have to have a client that's, okay with an extremely conservative asset like that, based on current interest rates. But yeah, we certainly could do annuities only, or could do annuities and life insurance. And on the same token, with a cash balance or traditional defined benefit plan, you could fund that investment. That plan could be investment only, or could be investments in life insurance. It could be annuities only, or annuities and life insurance.
Okay, I don't see any more questions, so I will take over exit strategies. So thank you very much. Stacy McMahon, just in time. Can you explain how the DB plan contributions can be higher than salary? Do you want to hit that real quick? No more questions after that,
Oh,
Stacy.
sure. And this is a common thing in defined contribution plans, 401k, SEPs. There's a limit, what can go in 58,000, or if there's a catch up, 64,500. Not to exceed 100% of someone's W-2 compensation, assuming a corporate plan sponsor. Pension plans define the benefit, or the benefit limit is what can be paid out in an annual annuity starting in retirement. And that can be no more than 100% of their high 3-year average compensation, or an annual annuity of 230,000 now, January 1st, it's going to go up to 245,000. So if that's my limit, right? And if I'm going to fund that in a relatively short period of time, I can certainly contribute a lot more to the plan than my W-2 compensation, if my W-2 compensation is somewhat nominal. So there's not an exact limit on defined benefit plan contributions compared to current W-2 compensation. It's more on what ultimately can be paid out of the plan.
Right. Well, thank you, Scott. I know we have a few other questions popping up here, but maybe with Carla's help, we can defer those to the very end here. So I will hit on exit strategies and take it from there. So what do you do at the end of the day when you want to be able to do something with the life insurance? When you retire, something has to happen. You just can't have the life insurance exist within the qualified plan. So you either have to surrender it, distribute it, purchase it from the plan, or if you want to be more exotic, you can even have your trust buy it. So we're going to go over some of those options right now. So why would you want to do this? When would you want to do this? What's the tax impact? That's what most people really want to know at the end of the day. And how does this fit into a client's overall planning objectives? So let's go ahead and see what this looks like. So options: liquidate, roll out, sell a policy to a grantor trust. The grantor trust I'm going to hit at the very end. It's kind of interesting with some recent developments with some pending tax legislation. So I'll have some fun with that at the very end. But in the meantime, let's just go ahead and move quickly through the first part. Okay, one exit strategy could be easy. And Scott and I have mentioned this a few times. You could simply, liquidate the policy within the plan itself. No immediate tax implications. You meet the objective of the overall plan. You do lose the life insurance coverage. So the self-completing, the tax-free portion of the life insurance obviously is gone at that point in time. I've seen a number of these. Scott, I'm sure has seen quite a bit more, but this is viable, and it often happens. They'll surrender the policy within the plan itself. What's interesting is some of the other options that are out there as we go on to this next one. Often individuals, especially in this environment, they want to be able to do something with the life insurance, especially since they've had their business, for the most part, pay and subsidize the premiums on a tax deductible basis this whole time. What if I'm not insurable now? What if I want to take this well-funded life insurance policy and use it to supplement my retirement planning needs outside of the plan? What if there are those transfer tax concerns? I want to get into an ILET. Okay. If you have a candidate that meets those criteria, one option is to distribute the policy from the plan itself. So it's like any other retirement plan distribution. You will be taxed on something called the fair market value. And I promised I'd return to that. And I got a couple chats asking me about that as well. 2005-25, Andrew, yes, that's correct. So there's this notice back in 2005, which, without going into tons of detail, if you have a distribution from a qualified plan, what they call a Section 83 transaction, like from employer to an employee, you have to use something called the fair market value to value what the tax impact of that policy is going to be. And what that is, it's going to be the higher of two numbers, what they call the ITR value, the interpolated terminal reserve. And there's some people I know out there, because I see their names, you know what that is. And then the higher the ITR, or what they call the PERC value, that's P as in Peter, ERC, PERC. premiums, expenses minus reasonable charges. It has to be the higher of those two. The good news is this: you don't have to compute that. I don't have to compute that. Most insurance carriers, Emeritus and many others, will compute that for you. We have a 712 form. You fill it out. We can give you the value of what that is. My point is, it can't be the wild, wild west, and you could just use what your idea of surrender value is or your idea of cash value. Last thing I'll say in 2005-25 is that this is what they call a safe harbor. So I've gotten questions from high-end advisors. It's like, I don't want to be forced to use this higher of the perk or ITR value. I think it should be something else, Andrew. I go, you know what? Knock yourself out. This is a safe harbor. This is what the IRS will more or less bless at the end of the day. If you could substantiate another figure and have it hold up, I'm not going to stop you from doing it. But again, this notice 2005-25 was meant to be an aid more than anything else. Okay, enough on that. Do know that there's a penalty if you go ahead and distribute it before 59.5. But let's go on to the next one, selling the policy. So you could do that. So you could, if you have enough money and you want to keep the money within the qualified plan, doing what it should be doing, you could purchase the policy again for that fair market value. You could purchase the policy. And again, you can get the value of that from the insurance company. There's not going to be a 10% penalty. Why? Because the penalty doesn't apply to purchases or what they call sale transactions. It applies to distributions. So no 10% penalty. So you can get it out before 59.5. You're meeting the income objective of the plan because the plan is being funded by the sale proceeds. I talked about the fair market value a little bit. Unfortunately, no credit for those cumulative economic benefit cost that I was showing you in our friend Tom's example, the dentist from earlier. No credit on a sale transaction. I have two transfer tax implication bullet points, which I really want to hit right now. I had one before, which I kind of glossed over. One option you'll see is once you get the policy, whether it's a sale or a distribution, you could transfer it to an irrevocable life insurance trust, what most people call ILETs. And you could do that for a plethora of different reasons. One of the easier reasons you might want to do that is you want to get the death proceeds outside of your estate. If you're the insured of a life insurance policy and the owner, you die, those death proceeds come right back in your gross estate. So what many practitioners suggest is you gift the policy. You could actually sell it if you want to a trust, an irrevocable life insurance trust. Keep the proceeds outside of your estate. Warning is if you die within 3 years of gifting it, if you do it the gift route, there's that 3-year look back rule. And so the proceeds will come right back into your estate. So if you are going to gift, just live 3 years. That'll help everybody. So you want those proceeds pulled back into your estate. All right, let's move on from here. Okay, this is the most complicated strategy. And the good news is we're not going to spend tons of time on this, but I do think it's important. What if you don't want to own the policy at all? You don't want to buy it. You don't want to have it distributed to you. This is a pure estate planning play. You want that policy in an irrevocable life insurance trust. That's an option. You can do that. The potential pushback, and I'm going to get over this hurdle, is under the prohibited transaction rules, you can't distribute a retirement plan asset to a prohibited person. And third parties, many trusts, are considered to be a prohibited person. The good news is this, and there's been revenue rulings and a couple PLRs on this as well. If you transfer it to a grantor trust is essentially your alter ego for income tax purposes. So it's as if it's going to you for income tax purposes. You're standing in the shoes of the plan participant, even though it's going to your grantor trust. So that's a possibility, is going right to the trust. The only reason I'm hesitating just a little bit, if you caught it in my voice, is that under the reconciliation bill that you've been hearing about all in the press lately, there's a provision in there which is not favorable towards grantor trust going forward. Without going into tons of detail, more or less, if you have, in this case, a life insurance policy and a grantor trust, you could very well pull those proceeds right back into your estate if the trust is worded inappropriately. One of the most common provisions in a grantor trust, one of the things that make it a grantor trust, is to utilize the income of the trust to pay life insurance premiums. If you do that in this situation, you can inadvertently pull those proceeds right back into your estate. I'm not doing this to worry everybody or even bringing this thing up, but we're hoping, and we got a lot of lobbyists, a lot of insurance carriers do, to hopefully have a pragmatic solution to some of these disturbing grantor trust provisions that are being proposed in the latest reconciliation bill. So obviously this is much bigger than just today's presentation, but I couldn't in good faith talk about this as a strategy without giving you a little bit of a warning. Okay, a couple more slides, and then we'll go ahead and open it up for any other questions we might have. And we got one of these questions already. And Scott, I know you and I are going to maybe tag team on these last few slides, but the value of working with a third-party administrator, huge. I could just tell you from an attorney in advanced solutions, advanced markets perspective, being able to rely on people like Scott and his team, it's golden. So we're not the ones to put together the case design. We're not the ones to take the census and integrate the life insurance annuities and investment products into a persuasive package that the advisor can bring back before their center of influence. That's people like Scott and his team that can work with us to go ahead and do that. And that's not even to mention the administrative, tax, and actuarial burden they're taken off of the back of you, the advisors that are out there right now. Let you focus on what you do best, which is knowing this area, bringing people to the table and seeing if this thing actually works. And it definitely will help you increase case size going forward. I'm gonna stop there. I know we have one more slide. I know, Scott, did you have any thoughts you wanted to share on this?
Yeah, it's very important to just have a TPA that you're, have a good relationship with, and certainly for any qualified plan, right? The TPA is very important. Any defined benefit plan. Once you start adding life insurance into a defined benefit plan, it becomes extremely important that you have a TPA or an actuary that that understands how life insurance fits inside of a qualified plan, what the overall strategy are, ways that we can build in flexibility. So whether it's our firm or there's some very other good TPA firms, you want to have one that understands life insurance, because that's not the norm. Unlike the 1980s, most of our plans don't have life insurance today. So there's some great benefits, great reasons why it improves the plan outcome for the business owner, but for you as a financial professional, I think it's important to make sure to find a TPA firm that understands life insurance and how it fits into qualified plans.
Absolutely. Well, thanks, Scott. I know we only have one more slide, and we have a few more questions at the very end I know we want to go ahead and get to. So at the end of the day, if you want to implement this arrangement with the last slide here, identify, qualify the clients. I think we did a decent job, I like to think, of painting a picture of what we're looking at by way of candidates here. Schedule the client meeting, formalize goals, aspirations, the ability to contribute on the part of the business owner. Obviously, we're going to have to get employee census. We have forms for that. Work with good people like McHenry and Associates with Emeritus that we have a great relationship with, and determine the best insurance contracts and other investments at the end of the day. Okay, that's the end of the formal presentation. Carla, were you going to help us with some of the questions, or should we just go ahead and check out the chat ourselves? Either way, fine.
I've got a couple of them already queued up. So can a client retire at 59 or younger using a plan like this?
Yeah, let Scott hit that, but the answer is yes. There could be penalties depending on whether they want to get the life insurance or not. But yeah, go ahead, Scott.
Yeah, that was part of the Secure Act that, even if you don't terminate a pension plan, you can now do an in-service distribution at age 59 and a half. So in practice, with defined benefit plans, what we normally do is keep the plan going for as long as the business owner wants to make large contributions or until they hit some benefit limit. If that's, if that's before age 59 and a half, then certainly that's a legitimate business reason to terminate a pension plan. And certainly if, we can keep the plan going after 59 and a half, we can even do new plans for business owners in their 70s, 80s. That's certainly possible.
And say a client has significant earnings for the next 4 years, say, and they're only 43 years of age. Will this concept still work?
Yeah, I will. I'm going to contradict Andrew, one of our earlier slides a little bit. I say at any age, you can do more with a defined benefit cash balance plan or fully insured plan than a 401k or SEP by itself. So believe it or not, we actually have plans for college athletes now with the name, image, and likeness income, where, very high profile ones, but where they can contribute, pretty close to 80, 90,000 a year on a tax deductible basis, even though they're in their early 20s. So yeah, definitely somebody age 43, high income 4 years, we can do the pension plan. If income dries up or, there's changes, then we terminate the plan once we have a legitimate business reason to do so. And we can always amend the plan. That's a way that we can add flexibility. We can always amend the plan to prospectively change the benefits and funding patterns.
And so here's another one. Would the TPA normally get put on a policy in the plan as a secondary agent to share commissions, or how does that work?
Yeah, so sometimes it depends on the TPA. It depends on the role that they're playing. We do a lot of kind of case design, pension plan and life insurance policy, and put them together for point of sale materials for a financial advisor. There's other TPA firms that work the same way. In that instance, it would be common to do that.
Yeah, and I'll add a few comments to that because we work with a couple TPAs, Scott being obviously one of them. And, today's not the day to kind of go into percentages and splits and things of that sort, but it's very commonly accepted in the industry. And after advisors, I haven't met one that once they're exposed to what the TPA can do for them from an accounting, actuarial, case design standpoint, that the split is minimal compared to the value that's returned. So very, very common in the industry for there to be a split, and the splits are very, very reasonable.
And then the last question that I have, is it allowed for a TPA plan to not allow for distributions before 60? Like, can you create a plan that doesn't allow for any distributions before 60 or 65?
Yeah. So there's lots of, you don't have to offer distributions until someone reaches retirement age. So even if they terminate employment at age 50, the plan could be written in such a way where they can't get access to retirement assets until 65. It's not that common anymore. And you've got to track somebody that may be a disgruntled former employee for 15 years. So we don't do it that often, but it's possible.
Great. I think that's all the questions we had because Andrew took some out of the chat early, which was awesome. Thank you so much. Thank both of you for doing this today. I think this was a real value add to our Impact Week.
Well, thank you, Carla. Thanks for moderating this and putting this on for Impact Week.
Absolutely. And again, these slides will be in the archives, and recordings will be in the archives as well. Great. Thanks, guys.
You bet.